All right, welcome to this explainer. We're getting right into the mechanics of cost behavior today to demystify exactly how numbers shift behind the scenes when business operations scale. So here's a question. Does cranking up production volume actually make things cheaper per unit? Intuitively, we always hear about economies of scale and just assume the answer is a straightforward yes. But the reality of cost behavior is much more fascinating, and it requires us to separate our expenses into some very specific categories. Here is our roadmap for today. We'll start with decoding cost behavior, move right into variable and fixed costs, look at the relevant range, unpack mixed costs, and tie it all together with the quality ornaments case study.
Section 1. Decoding cost behavior.
Moving to Section 2, understanding variable costs. Okay, first things first, we absolutely must establish the difference between looking at costs as a macro total versus a micro per unit metric. You can't just say a cost goes up or down as production changes. You have to specify if you mean the total bill for the company or the cost attached to one single unit of production. Keeping that distinction crystal clear is literally the master key here. So let's explore our first category, the shapeshifter of the accounting world, variable costs. Now, the crucial point here is the rule of constants. Variable costs increase in total as production grows, but they remain perfectly constant per unit. Think about it. If you produce 0 units, your total variable cost is 0. As soon as you start manufacturing, that total cost rises directly and proportionally with volume. But zoom in and look at it on a per unit basis, and that cost never flinches. To put some concrete examples on this from our source material, think about the raw materials physically used in production, direct labor, and sales commissions. They scale perfectly with volume. If it takes $5 of plastic and 2 hours of direct labor wages to make one item, it's going to take exactly that same amount to make your 1,000th item. The source also notes that delivery expenses operate the exact same way. They scale perfectly with volume in total, but remain completely flat per individual transaction. Section 3. Understanding fixed costs. Let's flip the script and look at the steady anchor of your business. We're flipping that rule of constants we just talked about. For fixed costs, the total remains totally unchanged in the short run, but it varies inversely per unit as your activity level changes. And this is where the magic of scaling actually happens. If you dramatically increase production, your total fixed cost doesn't change at all, which means your fixed cost per unit just got significantly cheaper. To ground this in reality, think of an assembly line. You're paying the exact same factory rent, insurance, and straight-line depreciation whether those machines are humming 24/7 or completely halted. Real estate taxes operate the same way. That total bill is locked in. Therefore, the more units you pump out of that factory, the thinner you can spread that massive total fixed cost across each individual unit. This really perfectly illustrates the stark inverse relationship between the two extremes, depending on whether you're looking at the total bill or the unit cost. Variable total goes up, unit stays flat. Fixed total stays flat, unit goes down. And, the source points out that financial exams and honestly real-world models often try to trick people by giving a fixed cost per unit for a given volume. Don't fall for it. Always convert that back to a total dollar amount, because the total is the only thing that actually stays fixed when volume shifts. Section 4, the relevant range reality. Because, let's be real, these rigid rules don't stretch out to infinity. The relevant range is your reality check. It's the specific band of normal operational capacity set by your current plant efficiency and supplier agreements. If you suddenly land an order for 1 million extra units, you might have to rent a whole second factory. Boom, your total fixed costs just jump to a new level. If you start buying materials in massive bulk, your supplier might give you a discount, altering that variable cost per unit. The rules of constants only apply as long as you're operating within your current normal boundaries, this relevant range. Section 5. Decoding mixed costs. So what happens when a single expense falls right into a gray area and doesn't fit neatly into either category? Well, a lot of real-world expenses are actually mixed costs. Take a utility bill, for example. It usually contains both a fixed base fee, just to have the electricity hooked up, and a variable usage charge tied directly to production hours. Notice how there are two distinct slices to this expense. To properly budget, you have to mathematically separate this mixed cost into its distinct fixed and variable pieces, so our rules of constants can actually be applied. Section 6. Quality Ornaments Inc. Case.
Let's bring all these rules together and prove the concept by classifying the expenses of a real manufacturing facility.
All right, here's the raw data dump for Quality Ornaments, Inc., a porcelain figurine manufacturer. Our challenge is to decode this puzzle and sort these expenses into total variable, fixed, and mixed costs. Looking at the raw numbers, we've got $3.2 million in labor, $6 million in materials, and $440,000 in plant depreciation. We also have to factor in $250,000 for production electricity alongside $100,000 flat heating rate. Throw in $10,000 in maintenance and $25,000 in formula-based deliveries, and it looks like a lot to process, but watch how cleanly it sorts.
Applying our rules, the variable costs total a massive $9,275,000. How'd we get there? We take the direct materials of $6 million, we add the direct labor, which is $3 million, and actually, side note here, the source explicitly points out that $200,000 of that original $3.2 million labor figure was an indirect contractual mix cost, so we're keeping that separate. Then we add the electricity at $250,000 and the delivery expenses of $25,000. All of these scale directly with output, maintaining a totally constant cost per unit. On the other hand, the fixed costs stay completely constant at exactly $540,000. That's composed strictly of the straight-line plant depreciation and the flat annual heating rate. Whether Quality Ornaments makes 10 porcelain figurines or 10,000, this $540,000 bill does not budge as long as they stay in their relevant range, meaning the cost per unit just steadily drops as they produce more. And finally, the mixed costs total exactly $210,000. This covers that $200,000 of indirect labor we mentioned earlier that had a base annual amount plus a variable rate, and the $10,000 maintenance expense that mixed a fixed weekday contract with variable weekend rates. So to wrap up this explainer, if mastering these building blocks allows you to instantly decode a complex setup like Quality Ornaments, what other hidden profit levers could you uncover in your own business as it scales? Understanding cost behavior isn't just a dry accounting exercise, it's literally the ultimate tool for strategic growth. Keep this mental framework with you, and you'll know exactly which levers to pull when it's time to scale.